Ladies and gentlemen, good day and welcome to the SMS Pharmaceuticals Ltd Q4 and FY’25 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. Today we have with us Mr. Vamsi Krishna Potluri, Executive Director, Mr. Lakshmi Narayan Taminidi, Chief Financial Officer, Mr. Tirumalesh Tuma, Company Secretary and Compliance Officer. I now hand the conference over to Mr. Vamsi Krishna Potluri, Executive Director. Thank you, and over to you, sir.
Good morning, everyone, and thank you for joining us on today's call. We appreciate your continued interest in SMS Pharma and the time you've taken to be with us this morning. I trust you had a chance to review our financial results and other investor materials that were uploaded to the stock exchange and our company website earlier. Let me begin by saying that FY’25 was a landmark year for SMS Pharma. We delivered a 39% growth in PAT, which marks one of our strongest earnings performances in our recent history. This was driven by volume growth, cost efficiencies, and continued focus on execution. These outcomes are the result of consistent strategy we followed over the last 4-5 years, built on scale-up, process optimization, and optimal product mix. I'd like to highlight a few important milestones on this journey. We've launched Asia's largest dedicated and automation production block for ibuprofen. We've invested close to 150 crores in backward integration projects for cost efficiency and margin sustainability across our API portfolio. Our facility successfully cleared EU GMP and US FDA audits, which is a reflection of our strong compliance culture. We added few new products, and in several of them we've already attained leadership positions. And most importantly, we've remained committed to maintaining a diversified product mix, which has helped us protect and expand gross margins, even through industrial cycles. Performance overview. Moving on to our financial performance in Q4 FY’25, revenue grew subsequently by 43% to 248 crores, showing a strong recovery in demand and execution. For the full year, revenue rose 10% to 783 crores, driven by good traction in anti-inflammatory and ARV products. We have also scaled up ibuprofen production significantly and are now among the top producers in India. Coming to profitability, in Q4, gross profit rose 18% year-on-year to 75 crores, with margins improving to 30%, up 444 base points. For the full year, gross profit grew 23% to 259 crores and gross margins improved to 33%, up 330 basis points from last year. This comes from a better product mix and benefits from backward integration. EBITDA in Q4 was 41 crores, up 21% year-on-year with margins at 16%. For the year, EBITDA stood at 139 crores, up 19% with margins improving to 18%. These factors translated into the strong profit growth I mentioned earlier. PAT for Q4 was 20 crores, up 18% from last year with margins at 8%. For FY’25, PAT grew 39% year-on-year to 69 crores, supported by margin expansion, volume growth and lower finance costs. Therapeutic and segmental update. Let me also take a moment to walk you through our segment-wise performance for the year. Anti-inflammatory and ARV segments were key growth drivers in FY’25. Anti-inflammatory grew 22% year-on-year to 148 crores. In ARV rose 15% to 163 crores. Anti-epileptic saw the fastest growth, up by 106% year-on-year to 29 crores, driven by strong demand and expanded market access. Anti-diabetic remained our largest segment at 185 crores, growing 5% year-on-year, despite prices softening this year. We have also seen strong growth in ED and other APIs, rising 15% year-on-year. Our focus on maintaining a balanced and diversified product mix continues to help us navigate volatility in any one segment and support margin stability over the long term. Strategic and operational highlights. We have also made meaningful progress on our long-term strategy this year, laying the foundation for stronger growth going forward. First, our backward integration project has received all the necessary licenses and approvals. Commercial production of key intermediates is set to begin this quarter. This will help materially improve margins starting Q2 FY'26. Second, we continue to deepen our customer base in regulated markets. In FY'25, we onboarded several large clients across our API portfolio and saw meaningful scale-up in key molecules. This improves not just the revenue visibility, but also the customer base. Third, we have approved a new CapEx plan of 250 crores over the next 18 months. This will support expansion in both existing and new products. The product mix of this capacity addition includes a healthy balance of high volume and high value APIs and will also expand our CMO business. Additionally, the board has approved a 10 crore investment in SMS Peptides Private Limited to be executed in one or more tranches. Fourth, we've made meaningful progress over building a robust pipeline of new molecules to drive our growth over the long term. Outlook. Looking ahead to FY'26, we are entering the year with strong momentum. We are targeting 20% revenue growth and aiming to expand our EBITDA margins by 20%. This should enable us to deliver another year of strong earning performances. Revenue growth and margin expansion will be driven by the benefits of backward integration, improved scale, and volume growth across our key products. Our recent announced 250 crore CapEx plan will further support this growth by adding capacity in high potential molecules. We believe we are on the right path, having laid a solid foundation for sustainable and profitable growth. With continued focus on execution, cost control, and quality, we are well positioned to end FY'26 stronger. Thank you. We are ready to answer any questions.
Thank you, sir. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Pranav Gandhi from Lotus Wealth. Please go ahead.
Thanks for the opportunity. I was going through the balance sheet and noticed that inventory was rupees 285 crores. If our gross margin is at 44% and the quarterly results are at 248 crores of revenue, we are holding inventory that is almost 7 to 8 months of our sales. On the other hand, we have got a debt of 311 crores on which we pay 20 crores of interest every year. Yet we are sitting on an expensive stock that doesn't add up. Also, why is that a company is keeping almost 3 times of what peer companies keep in their inventory?
Hello. Yeah, thank you. Thank you for your question. So, if I got your question correct, I think you're mostly asking about the inventory levels, right?
Yes.
The reason for the high inventory that we are currently maintaining. So, see,
yes.
Inventory that we are currently maintaining is because we have some high volume products that we are currently moving in terms of volumes, like for example ibuprofen, which is high volume product, and also we have some old products where we are sitting on some inventory, like HCQ and some COVID-related product which is not moving, but we are sitting on that inventory. But definitely in the next coming year, we have plans to reduce our inventory level. It will definitely come down, but definitely we will be carrying a higher inventory levels because we are sitting on commodity products where the delivery cycle is like my lead time for any orders that we get is hardly like 4 days or 5 days. So we have to sit on sufficient inventory, or else we run the risk of losing those orders. These products I'm talking about are commodity products that we're talking about, like ibuprofens or tenofovir or citalopram. These are all little commoditized products, and if we don't sit on these inventory, we will have a risk. We'll run the risk of customer placing the order to our competitors. So we are sitting on. So our inventory levels over the past have definitely increased because of the product mix and the different set of products that we are currently manufacturing. But definitely our plan is to reduce the inventory in this coming financial year.
I have a following question to this. How much amount of written off inventory are we looking forward in the coming years?
So no written off inventory. We don't have any. It's a slow moving inventory.
Suppose if I've got we have 80 to 90 crores of inventory from the COVID, which is more than 3 years, and it is impossible to use it in the following formulations and drugs. Shouldn't this portion be written off by now?
No, it is not 90 crores. It is 40 crores, and it is. And this is also not one product. This is HCQ also is part of that, and HCQ is not a COVID-related product. It is a regular product where we customers already filed our product in the US. They are anticipating a launch maybe in the next 2-3 months. So we have plans to liquidate that inventory sooner. So that's the reason, and it's a slow-moving inventory.
Okay. Also, I wanted to ask another question. To increase the ROC and ROE, we need to have a tight control on the inventory. What's the management's view on the inventory, supply chain management, and the efficiency?
So again, as discussed, right, I think we have plans to reduce the inventory going forward. Again, if you've seen our early track record, typically SMS is a very conservative company. We don't typically keep a huge inventory at our books. But cut to now, the product mix that we've come up with is products where our inventory levels need to be a little on the higher side. But definitely, I think based on the increase also in our top line, right? So our growth is also in that sense. So we are maintaining a little higher level of inventory compared to previous years. But definitely, I think that will go down in this year. But it will not go down to the level that was there like 3-4 years back, because that sort of level inventory is needed based on the products that we're currently manufacturing.
Okay. Thank you so much. And congratulations on your numbers.
Thank you.
Thank you. Participants, please restrict yourselves to 2 questions. If you have any more questions, kindly rejoin the queue. The next question comes from the line of Aryan Jain from Stern Capital. Please go ahead. Since the participant has dropped, we will move to the next participant. The next question comes to the line of Arnav Dharmashi. Please go ahead.
Congratulations on good set of numbers.
I'm sorry to interrupt, Arnav. We are not audible. Please speak a little louder.
Hello, is it better? Hello?
Just a little. Yes, please be a little louder.
Yeah. So congratulations on good numbers. So one, I just wanted to understand that in terms of our gross margin gain, what percentage of gain came from backward integration?
Sorry, I didn't get you. What percentage came from
gross margins have gone up. Yeah. So gross margins have gone up on account of better product mix and backward integration as well. So just wanted to understand how much of that came from backward integration and how much of that was from product mix.
So product mix, I think I would say around 60% product mix. I think 30% from backward integration, because our backward integration product, the project was just commercialized in, not fully, but part of it was commercialized in the last quarter. So this year, I think that percentage will be much higher for backward integration projects. So this for FY'26.
Okay. And we've spoken about some of, we're looking at launches for our API intermediaries. And so what kind of pipeline are we looking in terms of our API supply?
So we are very strong in a certain therapeutic categories, definitely. So those therapeutic categories are a key focus. And along with this, we have some interest from few other customers for different products. So we are looking at a mix of our existing therapeutic categories, also a few categories which we are attracting good interest. So it's a mix of both.
Okay. And last question is for the incremental 250 crore capex that we are looking for over the next 18 months, what kind of asset turn are we looking at on that capex?
So we are looking at an asset turnover of 1.
No, okay. I'll join back in the queue. Thank you so much.
Thank you.
Thank you. The next question comes from the line of Surabhi from NV Alpha Fund. Please go ahead.
Hi, thanks for the opportunity. So my first question is regarding your ibu segment. So your ibuprofen currently, what is the mix that you are selling in your regulated markets versus the non-regulated markets? And how much of your ibuprofen would be backward integrated currently?
So right now, it is around, say, maybe 40% to regulated markets and 60% to domestic and ROW markets. Like when I say regulated market, I'm including the deemed export also. So where the product is sold in India for the end finished dosage sales in the US. So I'm considering that I think it's around 40% to the regulated market and 60% of our listing is to the domestic market. And coming to the backward integration part, so we have two major intermediates. One of them is already backward integrated. The other one is in the pipeline.
Got it. And you also mentioned about backward integration for some of the other APIs. So is this going to be in the high volume API segment or the high value API segment? And just a follow-up to the previous one, is there scope to increase your ibuprofen share in the regulated markets from 40%? Like, can that inverse to like 60%?
Yes, definitely. I think it can definitely. So the thing with regulated market is so one by one we are getting approvals from some of the US customers. So the US, it takes time, right? So they have to take validation batches, they have to notify stability, file their PS, and then they get commercial approvals. So apart from these customers, I think we are targeting a good number of regulated customers where our product is already sampled and that it's at various stages for different customers. For sure, next year, definitely that proportion is going to increase, not to 60, I think it might even go to 70% also. So that's the plan, but slowly, one by one, once we start getting customer approvals, it will take time, but we'll be getting them soon. And I'm sorry, what was your other question?
So what other APIs are you looking at backward integration? Like which therapies? Is it the volume category or the value category?
So actually it is mostly the volume categories, like 80% major focus will be on the volume category because that's where the cost pressure is. On the volume ones, like some of the anti-diabetic segment is a critical one, and anti-epileptic is one segment we're currently looking at. And low volume are decent margins. So currently, like our focus is there, but it's limited. Most focus is mostly on the high volume ones.
Got it. And just last question, what is your current capacity utilization across both facilities?
It is around 75 to 80%.
Got it. Thank you so much. Thank you.
Thank you.
A reminder to all participants, you may press star and 1 to ask a question. Participants, please press star and 1 to ask a question. The next question comes from the line of Anmol Jangu from Shanika. Please go ahead.
Yeah, hi. Thanks and congratulations for a good quarter. Just a couple of questions. One is that what is our capital expenditure plan for this year, the outlook, as well as what did we do in terms of CapEx for the last year?
So the CapEx that we've spent in FY'25 was around 150 crores. As discussed earlier, it was mostly for backward integration of some of our key APIs. So that was where the CapEx has gone through. For this year, the CapEx is close to around 250 crores. So we are adding new blocks and where we'll be manufacturing, increasing the volumes of our existing product mix, and also we'll be adding new products, and also we'll be dedicating some capacity for CMO also, where we are actively getting a lot of interest for some of our, for the plant, we are getting a lot of interest on CMO activities also. So it will be a mix of 3-4 segments that will be spending this 2026 CapEx on.
So just help me understand this, Ramshit. So the last year, 150 crore that we spent in terms of addition to net of the maintenance CapEx, what is the asset turn that we are aspiring for on that? And when you are making your capital allocation decisions in terms of, what are the areas you're going to be investing in, what is the basic maths that you're working with, and how do you see this addition to this gross block start contributing to revenue, and in what time frame? So if you could just walk us through this whole thought process in detail, it would be helpful.
Correct. So last year, based on our investment, I think the 0.67 is the asset turnover. Actually, total asset turnover last year was 0.67 for FY'25, and definitely I think this year again it's gone into the cap. So the capex, as I was highlighting in my speech, the vertical integration, the block setup, everything is completed. Right now we are taking validation batches at this point of time. So the revenue will start factoring in, the margins will start factoring in. You will see a increased revenue from Q2 FY'26 for the last year project that we've done. And coming to this year, we are adding 250 crores approximately to add new block, to add more products and increase our capacities for our existing products. So definitely I think this revenues, so we are again targeting an asset turnover of 1. So for FY'26, and we are anticipating that commercials to start in early FY'27.
Right. So basically, with a lag of 12-15 months, your each capital expenditure, should yield an asset turn of 1. Is that fair in terms of understanding? And the incremental capex that you're spending, say for example, if you look at the 250 crores, there's a part of that which is going to CMOs, etc. And if you benchmark it against peers, that number tends to be higher than 1. So, any thought process there, because 1 is just right on the fence, and given the commodity nature of some of these products, there could be reasonable periods of time where even cost of capital can't be recovered. So on a blended basis and also on an incremental basis, when you're doing your capital allocation decisions, what are the areas you're trying to get into, and how are you thinking about the cost of the capital versus return on a sustainable basis? You take the point that there'll be a lag between the time you put capacity and it starts yielding, but on a consistent, steady state basis, what should the asset turn be, and what is it that you're targeting?
See, the target is 1, to be honest with you. Right now it is 0.67. If you look at our pharma industry, I think the average that is currently at this point of time, from our peers, almost 20 companies, very close to us, is close to around 0.6 to 0.7 range. Okay, so we are targeting to be around 1, which is a very, very good number and very aggressive number. But right now we are at 0.67, which is as per the industry standard at this point of time, the total asset turnover to that's the thing. And with respect to the margins that you are mentioning, see, if you see that though you mentioned commodity products, right? So though we are doing products like ibuprofen and which are very commodity in nature, if you see our profitability has gone up significantly. I think this year we've closed at 40% higher PAT than the previous year. So my thing is like, though we are working on commodity products, that it is more crucial that we are vertical integrating on some of these products to make sure that our profitability remains and our profitability increases. That is the target that we are planning to do. And again, to coming back to your question, I think we are targeting, our target will be asset turnover ratio will be 1.
Does that answer your question, Anmol?
Yes, it does. Thank you.
Thank you. The next question comes from the line of Shri Hari from PCS Securities. Please go ahead.
Yeah, hello. Am I audible?
Yes.
Yeah, please.
Yeah, thank you. So for your main two therapies, that is anti-diabetes and ibuprofen, if you could please share the volume growth, and I would also like to know the price outlook for the two segments. Thank you.
So price for ibuprofen has sort of stabilized right now. It's stable. I think since last 1 year it was on the downtrend, but since last quarter it's sort of stabilized, and it's at a good point. And with respect to the growth, so volume growth, I think it was 22%. Anti-inflammatory ibuprofen is around 22%, and anti-diabetic growth in terms of volume was around 5%. So, in anti-diabetic, I think we have 2-3 critical products on the anti-diabetic segment, and so we anticipate the same volume, because on the anti-diabetic segment, one key factor was that the patents have gone off, but still we were able to retain the market share and retain the volume, which was a very good thing. The patent went off in Europe in 26, so we were in 25. So we were still able to retain that market share. And anti-inflammatory, I think we are taking good steps to increase our market shares.
Sir, if I'm not mistaken, the value growth was 22% and 5%. I wanted to know the volume growth.
So currently I don't have the numbers. I think it will be around
2,200 for the current year, FY'25. 1,800 is the previous year.
Volume.
Ibuprofen.
Okay.
1,800 tons.
1,800 tons was what we've done last year, and I think 2,200 tons was what we've done this year.
And can I have the corresponding number for sitagliptin?
So sitagliptin, I think, is a little more confidential because it's a joint venture project. So unfortunately, we'll not be able to disclose the exact volume that we've done at this point in time.
Okay. Any target for ibuprofen volumes this fiscal?
So we are targeting close to around 5,000 tons this year.
5,000 vis-a-vis 2,200?
Yes.
Okay, fine. Thank you.
Thank you.
A reminder to all participants, please press star and 1 to ask a question. Participants, you may press star and 1 to ask a question. The next question comes from the line of Arnav Dharamshi from Ashmi Enterprise. Please go ahead.
Hello.
Yes, please go ahead.
Yeah. I just wanted to check. Is there a possibility where we are able to gain some market share on ibuprofen side, say from the large MNC competitor, on account of better pricing?
Sorry, could you repeat that question?
Is there a possibility where we are able to gain market share from a large MNC competitor on ibuprofen on account of better pricing and good product?
Yes, definitely. I think, see, we've launched this product 1.5 years back, and we have a decent market share right now. So definitely, I think the market share, I mean, the volume for ibuprofen has not increased significantly. It's sort of stable, right? But once we are getting more market share, we are obviously taking it from a competitor right now. So we are definitely taking it from a big competitor. We're pulling some market share based on the pricing.
Understood. And secondly, I think so large part of our CapEx has been focused towards backward integration. What are your thoughts on growth?
Growth, in the sense, growth.
I mean, growth, I mean, for the business over the next 2-3 years, how do you see the business shape up over the next 2-3 years in terms of revenue quality?
So again, Yeah, so we have basically, again, so last year what we've done was for backward integration. So that revenue will come in Q2 FY'26. So the revenue you will see from the last year budget, backward integration, you will see in Q2 FY'26. And this year again, we've taken up a 250 crore budget to add new products and also increase the capacities for existing products, not only ibuprofen, but we have few products that is catching good interest. And also CMO is a good space that we want to, we are already there in the CMO space, but we are adding more new products on that space. So this additional capex that we're doing will fund all this. And again, as highlighted in my speech, we are anticipating a 20% growth on the top line and a 20% growth on EBITDA as well for FY'26.
Okay. I just want to clarify, I think from your press note, you have given 20% EBITDA margin as guidance. So is it 20% EBITDA margin for the guidance or 20% EBITDA growth?
Sorry, I stand corrected. I think it is 20% EBITDA margin.
Okay. So, okay. And say from Q2 FY'26, what kind of gains are we looking at led by backward integration? Because it is by then that we'll have a full cycle payout. So by what kind of gains are we looking at? Led by backward integration on gross margin.
If you see our PAT margins have increased significantly, I think almost close to 39% to previous financial year. Again, we are anticipating a growth of, I think, around 20% on the conservative side for the margins for the next financial year also. So in a landscape where there is a lot of pressure on pricing and we are able to navigate this through backward integration and trying to be more cost effective and get some market share as well, and at the same time increase the profitability.
Right, sir. But my question was regarding largely on gross profit starting Q2, because you mentioned in the presentation and you spoke about it. And say in Q4, our gross margin was close to 30%. So because of backward integration, what do you see that number go to, say from 30% to what number? Because of the backward integration gains that we make.
See, I'm not talking about this thing. So what I said was the entire year is 20%. Will be around 20% growth.
Okay. Got it. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Vamsi Krishna Potluri for the closing remarks. Thank you, and over to you, sir.
Thank you all for joining us today. FY'25 was a year of a strong execution and meaningful progress across our strategic priorities. As we enter FY'26, we do so with great momentum and a clear focus on delivering stronger revenue growth and margin expansion. We appreciate your continued trust and interest in SMS Pharma's journey. For any further information or clarification, please feel free to reach out to our IR partners, EQS Ponent. Wishing you a great day ahead. Thank you.
Thank you, sir. Ladies and gentlemen, on behalf of SMS Pharmaceuticals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.